All Stars webinar. We have the complete lineup today, all our fund managers and our CIOs on the platform to answer the question. So I'll just begin by setting the context. Why are we deviating from our typical norm of having a CCP webinar or a KCP webinar or a Little Champs webinar and having all three on the same platform? Over the past couple of months, we've received a lot of queries, which are very, very common to all our investment funds. These are about our investment philosophy, to say so, because the investment philosophy is common to all our strategies. So we thought rather than addressing them separately in each of our webinars, we'll organize one of these and get all three of our fund managers to address those questions around the investment philosophy and how those aspects of the investment philosophy apply to their strategies individually. So to begin with, I'll hand it over to Rakshit to kick off the proceedings, and then we'll go on to Kings of Capital and Little Champs before we open it up to Q&A in about 40-45 minutes time. Over to you, Rakshit.
Sure, thanks. Thanks, Pramod, and good evening, everyone. A very warm welcome. So today we'll discuss subjects such as why do Marcellus's portfolios deliver consistent wealth creation, regardless of whether we are in a bull market or a bear market, and then we'll also give some comparison on risk-reward matrix of CCP versus LCP versus KCP. So let's start off with basic mathematics, which some of you might have actually seen in our previous presentations. It's a non-debatable equation which breaks down the price movement of a stock into two factors. The first factor is the P multiple, or in fact, you can take the ratio of price to any fundamental, whether it fundamental metric, whether it be price to cash flow or price to EBITDA, etc. Now, price to earnings, PE, or any such multiple is an oscillating factor. You would never see PE multiples go from 5 times to 50 times to 500 times, so on and so forth. It largely oscillates between doubling, halving, or at max, it might be 3x, 1/3, not more than that. Now, if that is the oscillating factor in the equation, then it's quite interesting to see that the second factor is a reverse opposite. It's a factor which can compound sustainably over long periods of time, which is the fundamental of the stock, right? It could be earnings growth, free cash flow, etc. And hence, there are a few conclusions worth drawing from this slide when you combine the oscillating and the compounding factors together. First of all, for weak earnings growth, even PE multiple timing doesn't help get a satisfactory outcome, right? For strong earnings growth, in fact, a bad timing of PE multiple also doesn't generate an unhappy outcome, right? So those are the three scenarios given here. If you've got 0 earnings growth or 10% earnings growth, then even PE multiple expansion can't bail you out. And if you've got 25% earnings growth, then even a PE multiple compression can't take away the satisfaction of the outcome. And the second interesting conclusion is that if the share price of the stock is a combination of an oscillating and a compounding factor, then the stronger the compounding factor, the less effective become the oscillating factors in share price compounding, right? So let's take a few practical implications of this piece that I just talked about, right? Beyond just mathematics. Now, if you look at factors such as, say, macroeconomic growth rates, competition, disruptions, black swan events, regulatory changes, so on and so forth, these are all oscillating factors, right? They come and go. Whereas when you look at fundamental compounding of stocks, they are actually the real drivers of satisfaction in wealth compounding as per this equation. So whether it be the PE multiple or an event timing or anything else, as long as it's an oscillating factor, it's not worth relying on it for share price compounding. Now, bearing that in mind, let's go to this piece, which is also an exhibit from one of our previous publications. So in our first January 2020 newsletter, we published this simple analysis. It's a simple DCF where what it is saying is that as is quite widely accepted, the valuation of any company is the fair value of its is the present value of all its future cash flows, right? Now, when investors build their expectations of future cash flows, then there are two factors that that drive those expectations. One is the rate of compounding of fundamentals in the foreseeable future, and the second is the definition of the foreseeable future itself, which means do you expect a certain rate of compounding of cash flows for a company to continue for 3 years, 5 years, 7 years, or much longer than that, right? That piece in terms of what's the longevity of free cash flow compounding that a business should be attributed to is actually one of the most important questions in arriving at valuation of any company. And the answer to this question, what is the longevity of a business? The answer to this question eventually becomes the biggest driver of share price compounding, because this many at times this becomes the most undervalued component of fundamentals in any stock price, especially of great quality companies, right? One of the biggest drivers of undervaluation of great quality companies is the longevity of cash flows, right? And the table that you see at the bottom, it shows you how the outcome of this exercise significantly changes the moment you toggle across different answers on longevity of a company, right? If you believe that a firm is going to compound 25% earnings for 5 years, then it's actually very expensive at PE multiples, anything north of say 25 times. And if you believe a firm is going to compound 25% earnings for say 15, 20, 25 years, then even at 100, 150 times PE multiple, the last column on the screen, you can see will be a very cheap level of PE multiple for that sort of a company, right? And hence the importance of figuring out the longevity of a franchise before arriving at an answer to the fair value of any company, right? Now, if longevity is so much more attractive, so much more important for a high quality company, then the next big question that an investor needs to answer is how can you differentiate between longevity of two companies, right? Because if two companies both are likely to compound over the next 3-4 years at the same pace, how can anybody, because nobody has seen the future, how can any investor, any fund manager say that one of the two companies needs to bake in its valuation uncertainty beyond 5 years, and for the other company valuations need to bake in uncertainty beyond only 20 years, not before that, right? So that piece becomes very critical. At Marcellus, we implement a research framework called the longevity framework, which you can see on the screen in front of you. It's got basically 4 verticals. For the sake of simplicity, let's divide this slide into 2 parts. Right, the left-hand side part is the here and now, and this is the most straightforward stuff: earnings growth, return on capital expectation, what's the strength of the pricing part of the business as it stands today. Right, that's the piece which sort of I would say is very well. I would, at least as a requirement for investing, this piece is well known, as in you need to assess the pricing power of a business before you arrive at any sense of fundamental expectations. What is not so widely appreciated, and that this is where the opportunity lies, is the piece on the right hand side and its contribution to longevity of a business, right? So the piece on the right hand side, as you can see, it's got 2 factors. One we call as the lethargy score, or the lethargy parameter, which relates to capital redeployment back into the business once today's business has already become a massive free cash generating high ROC company, right? Where will that free cash be redeployed back is what the lethargy score captures. And the second aspect is the succession planning score, which captures the softer side of business management. Quality of management, as people call it, is actually a very good summary of the vertical on the extreme right. But it's important to understand what sort of a quality are we really seeking here, right? What we don't want is that a company which is run by high quality management, but that management is a one-man show. What we also don't want is at a ground level, a particular geography does well because the head of that region is an exceptionally high quality talent as an individual, right? We don't want centralization of quality, if at all. We want decentralized execution at the ground level, decentralized strategy at the top level, and then we also want to see institutionalized senior management succession planning, which means that it shouldn't be that the CEO is hiring all CXOs at a firm. CXO should be actually appointed by the board. The independent board of directors should not be independent just by their designation. They should truly have the empowerment and the ability to shoot down the suggestion of a promoter in a board meeting. It's always great to have some sort of a historical evidence of having gone through changes in the CXO layers, having gone through succession planning in the promoter's family, if they are involved in the business, having gone through sort of scalability via systems and processes, so on and so forth, right? So those are the aspects which we seek in terms of longevity beyond the next 3 to 5 years that a business should demonstrate. And these are all tangible bits, right? None of this is sort of blue sky scenario building. So if in lethargy we are looking at radical disruption, the seeds of radical disruption should have already been sown, right? And the report should show, or at a ground level, we should see certain steps being taken in the direction of completely changing the rules of the game in the entire industry in order to make the business irreplicable over a longer term. We need to see evidence that that the way competition gets suffocated today is not going to be the same way that the same competition will try to be competed against by this company 3 years, 5 years down the line. We need deepening of moats, we need widening of canvas, so on and so forth, right? So it's this piece, the piece on the right hand side of the slide, which I think is the most undervalued aspect of longevity for most high quality businesses, where if you can quantify this, right? Obviously, this is not going to give you the next quarter or next 2 years of earnings growth expectation. It's longevity. If you can quantify this somehow and differentiate between, say, the longevity of an Asian Paints and an HDFC Bank, or between an HDFC Bank and a Relaxo Footwears, then that's where I think position sizing is a massive value addition of this exercise that delivers a very healthy risk reward in any portfolio, and also that's where, if you bake this into the, let's say, present value of future cash flows via the DCF in the previous slide that I showed you, it might actually suggest some companies are exceptionally cheap at 50-60 times P multiples, and others are actually exceptionally expensive at 20 times P multiple as well. So that's something we do at Marcellus. Now, let me quickly cover up the consistent compounders, a couple of slides, and then I'll pass it on to Ashwin and Tej for LCP and KCP respectively. When it comes to the free cash flows of consistent compounders, this is actually a very interesting slide and worth absorbing, understanding thoroughly. The table on the left hand side, right, this piece, the table on the left hand side is free cash flow of our non-financial CCP companies over the last 20 years, in the column on the extreme right, broken down into time periods of 5 and 10 years each, right? So you can see the time periods on the top, and when you look at the weighted average free cash flow compounding, right? There are two or three very interesting messages coming out from this table itself before we come to the table on the right hand side. So let's just focus on table on the left for the time being. First and foremost, free cash flow compounding for our portfolio companies has been at around 25% for the entirety of the last 2 decades, right? If you split that 2 decades into sub time periods, right? Every sub-segment of the last 2 decades has also been equally healthy rate of free cash flow compounding, which means it's been a very consistent free cash flow compounding over the last couple of decades, right? What's actually also very interesting is that it's an accelerating trend of free cash flow compounding over these time periods. So for instance, the last 5 years, 39% was much higher than the preceding 5 years. The last 10 years, 28% was much higher than the preceding 24%, right? And this is actually against the notion that as companies become large, their growth rates tend to fade away, right? This is against that notion because where we've previously shown you, India as a country is becoming polarized. These companies are playing the polarization of the economy to the fullest. And when you really understand what these firms are doing, over the last decade, almost all of them have significantly leveraged on technology investments to compress working capital, to expand asset turnovers, and hence deliver free cash flow in an accelerated rate of compounding compared to what they used to do till 10 years ago, right? So those are some very interesting and important messages to take home from the table on the left. And then when you join that with the table on the right, table on the right is share price compounding, CAGR, over the last 20 years. Remember, this doesn't include dividends. This is just share price. When you look at share price compounding, it's actually matched hand in hand with free cash flow compounding, right? For every sub time period, as in the smaller time periods, as well as for the entirety of the last, say, 20 years, right? And that's actually the most comfortable position for any investor to start looking at a company, because if historical fundamentals have compounded at a healthy and consistent pace, and market cap has not compounded at a pace faster than fundamental compounding, then you can't have a better starting point to start looking at a company to begin with. And then when you look at the forward-looking piece and see how these companies are actually beneficiaries of every disruptive environment. For instance, the last 5 years were probably the most disruptive out of the last 20, because last 5 years had demonetization, GST, and COVID. And imagine all of these 3 black swan events, how badly they have affected the broader industries within which all of these 10 companies operate, right? And despite that, they've done this, and which is actually nothing but market share gains. That's something which is a wake effect of a deep crisis that we'll, I think, continue to see over the next 3 to 5 years. And hence, we are actually quite optimistic about the continuity of healthy rate of compounding of free cash flows in the foreseeable future for these companies. Now, quickly coming to another way to look at the performance of our portfolio. When you compare it against benchmark, so the previous slide was more about absolute fundamentals versus valuation. This slide is more about relative fundamentals versus valuation. When you compare our portfolio's fundamental compounding, let's say measured by earnings growth. I mean, unfortunately, we can't do free cash flow because Nifty, most constituents just don't have a positive free cash flow here. It's a sad state of affairs. But if you look at earnings growth, the alpha or the outperformance of our portfolio against Nifty 50 on earnings growth matches 1:1 with the alpha or outperformance at a share price level between our portfolio and Nifty, right? So for instance, the 27 minus 13 alpha that you see in the extreme right column of the right-hand side table, which is the alpha on share price compounding is the same as 18 minus 4 earnings growth over a similar period, right? So that's actually quite important to note as well, because as long as our portfolio companies keep gunning out better and better fundamental compounding over the longer term compared to the index, the ability to beat the index is simple, straightforward, and just an outcome. Don't have to worry about it. So that's this slide. And where does this superior earnings growth come from? So it's a combination of first, high returns on capital employed, which means cash generation, and secondly, high rate of reinvestments, which you can see 50% of the cash which gets generated by these portfolio companies is pumped back into the business to grow the capital employed, and on that reinvested capital, again, a high degree of return on capital is generated, right? So that's as simple as it gets. It's a very sustainable, very difficult to build, but very healthy machinery of cash compounding that our portfolio companies have created here. So at this point, I'll pass it on to Ashwin to take you through fundamentals of Little Champs portfolio. Ashwin.
Yeah. Thanks, Rakshit. Rakshit talked about the fallacies of the conventional DCF approach, and I believe it is particularly true for the small cap companies, primarily because of the two reasons. Because of the small size of these companies, the earnings as well as the cash flows over the near term tend to be very lumpy in nature, and secondly, because of the short operating history of these companies. As a result, using conventional DCF method or a price to earnings multiple, which focuses more on the near-term earnings, near-term cash flows, we may end up underestimating a great franchise, or we may actually overestimate an undeserving franchise. So let me give you some examples. So for example, if a company which is dominant in one market, it is generating good cash flows, it has a top line of say around 500 crore, it decides to go for a pan-India franchise. So the natural thing for that company is to put up a new greenfield plant. It will invest in talent, hire good people from the market. So what will happen is that because the business is small, the near-term impact on earnings will be quite pronounced. So because this new plant, will be up and running in say next 2 to 3 years, it will reach an optimum capacity utilization in another 2 years. So it will be, we are talking about 4 to 5 years when the cash flows from this new business will, or the earnings from this new venture will actually start contributing. So the under the conventional valuation method, because the near-term cash flows are suppressed, because the near-term earnings are suppressed, we may actually end up underestimating the value of that firm. But it may be very much possible that over the next 5 to 6 years, the addressable market of the firm actually increases manifold, and actually the cash flows improves dramatically over the long term. So this is one example where actually there is an opportunity lost. But flipping the argument, other side also, a company may be here and now doing very, very well actually, but it may turn out that, and actually because it is actually driven by a fad, rather than the capability of the management. And in small caps, we come across these numerous examples, where the greatness of the firm doesn't last very, very long actually. So the management may be completely incapable, maybe lethargic, sleeping on the wheels, etc. So as a result, the company may generate very good earnings, cash flows over the 3 to 4 year period, but it could suddenly fall off the cliff actually. So again, under the traditional DCF method or the price to earnings multiple, there is a risk that we will be overestimating the value of this firm. And this is also evident. Such cases is also evident looking at the simply at the turnover of the BSE small cap. So we have been highlighting in our Little Champs presentation. So around 50 to 60 companies exit the BSE small cap every year. I know this is nothing but these companies, which are currently doing well, but they are not able to sustain the earnings and cash flow over a long period of time. So here our longevity framework actually helps us address these issues. I think many of you asked the question to us, these Little Champs are primarily into the B2B businesses, so what is the growth driver for them, or the long term they are into the niche business? So the growth driver has to be on the right hand side of what the Rakshit showed on the longevity framework. So they should continue to expand their niche, say from one market to another market, or they should add new growth drivers like targeting the adjacencies, etc. And that is how the Natal Champs companies have actually defied the overall slowdown, the macro slowdown which we have seen over the last 5 to 6 years, the disruptions that we have seen over the last 5 to 6 years. So on the screen, actually, you can see that Natal Champs 6 years earnings CAGR has been close to 18%. And if I remove FY21 being an exceptional year, actually the earnings compounding between FY16 to FY20 has been close to 26%. Whereas the corresponding earnings growth for BSE small cap has been close to 7 to 8%. So Natal Champs have actually grown fast, thrice that of the BSE small cap index earnings growth. And this has come primarily from this right hand side of the longevity framework. So they have been continuously deepening their moats. They have been investing in talent. They have been investing in technology. As a result, they continue to gain market share. Secondly, they have been expanding their addressable market. So either taking their niche from one market to say pan India. In fact, most of the Natal Champs names that comes up on the screen, they have now also built a very credible global franchise actually. So I think some of them actually may be ranking in top 3, top 5 in the global markets. And also one thing about the small cap companies that as you build scale, you need to invest in talent. So when the company is small, actually the promoter can be at the helm of the affairs. He can be a driving force. But as the company builds scale, as it enters new geographies, new adjacencies, you have to necessarily bring in professional talent and you have to delegate power. So I think some of you have already asked the question, why do some companies or rather most of the companies after entering BSE 500, why do they underperform? That is the primary reason actually, because while to some extent up to a certain size, the promoter can well manage the show, but after some time, you have to delegate, you have to bring in more talent, and that is how you grow the business. Natal Champs have clearly outperformed the BSE small cap as far as the earnings is concerned. But more importantly, moving to the next slide, this earnings growth has also been complemented by strong free cash flow generation. So if you look at between FY16 to FY21, the compounding of the free cash flow has been close to 28%. So that is clearly 10 percentage points higher than the earnings growth, actually, what has happened. And this is not because they have held back on the investment. In fact, the reinvestment engine of Natal Champs, I will show it in the next slide. It continues to be, accelerating actually as we speak. Where the cash flow generation has really benefited besides the earning growth is these companies have been able to bring their working capital days significantly over the last 5 years. And that has been enabled primarily because of two reasons. One is the investment in technology. So because of the investment in technology, they are able to better estimate the market demand. As a result, the inventories for most of these companies have seen a marked reduction over the last 5 to 6 years. And more importantly, as these companies have gained market share, as they have built their dominance, they have also been helped by improving bargaining power. So both from their customers as well as from their vendors, actually. So as a result, the debtor days have come down for most of these companies. The trade payable days have actually increased for most of these companies. So clearly, the free cash flow generation has been driven by operating cash rather than any reduction in the capex spends, basically. And we see that because of this COVID, what has happened in the last 1.5 years, while the Natal Champs earnings have not seen much hit, their free cash flow generation, in fact, has seen an acceleration in FY21. As a result, their balance sheet position is, they are from a balance sheet perspective, much stronger position compared to their peers than what they were 1.5 years back. So on the screen, you'll see that the net debt equity has actually not changed much, but that is a relative because the equity has also increased. So on a higher equity base, they are able to maintain the net cash position. So the absolute level of net cash on their balance sheet has actually increased significantly in the last 1.5 years. And this gives them all the more firepower to continue or rather accelerate the market share gains over the next 3 years, foreseeable future. So Rakshit, if you can move to the next slide. Yeah, and in fact, we have seen visible in the recent actions. Actually, we have seen, most of the Natal Champs companies have actually pressed the accelerator for market share gain. So you can see that on the last column, actually, most of the companies actually are going for strong organic expansion. In fact, some of these companies like GMF Fowler actually bought their peers in the market. And I think this places them in very good state for the next 3 to 5 years. In fact, some of the steps are not covered over here. So here the slide focuses mainly on capacities and the physical assets. But we have also seen over the last 1 year, most of these companies hiring good talent actually. So for example, Suprajit has recently hired a global head for their cable and control business. Garware last week actually announced that they have hired a senior person from MOI to head their Scotland aquaculture business. Lumex, for instance, actually got in a veteran automotive lighting expert too, and they are actually developing their R&D center in Europe. So there is clearly retail champs have gained market share over the last 5 to 6 years, but because of COVID, we think that would only see an acceleration over the coming years actually. So as a result, we remain very sanguine and confident about the earnings growth prospects. And similarly, I think the cash flow acceleration should continue because the dominance, the bargaining power should only increase from here on. So as a result, the cash flow situation should also continue to remain very strong. Yeah, I'll stop here and I'll hand over to Tej.
Thanks, Ashwin. So on KCP, again, we use the framework which Rakshit explained earlier. That is, we rank companies basis their moats, basis their lethargy and the institutionalization that the companies have done. Now, the difference over here and where we tweak this framework a bit is that because these are leveraged companies and the barrier to entry is usually around either technology, execution, or the use of technology for collections, for underwriting, or for improving productivity gains. So the way we try and analyze the moats for these businesses are around these three aspects. And because 80 to 90% of the earnings of lenders or financial companies are reinvested back into the business, because capital is the raw material largely over here in this business, we look at how these companies have allocated capital historically. And it sort of becomes a virtuous cycle. If we have historical evidence of barriers to entry around execution, technology processes, and then using the earnings which the company has earned over the past many years and redeploying those earnings properly into ROE, into businesses which generate incremental ROEs over cost of equity, then we are able to build conviction to say that this is a company which is sustainably going to grow at 20-25% for the foreseeable future because they've been able to allocate capital well. And what this leads to is a virtuous cycle where you are able to see that 80 to 90% of earnings are generated. You're able to lever that up 6, 7, 8, 9 times because lenders raise debt which is 6 to 7 times of their equity. That debt is again redeployed into the business, and overall on that capital, you are able to generate return on capital above the cost of capital. And that is a virtuous cycle that we've seen a lot of lenders in our portfolios follow over long periods of time to create substantial shareholder wealth. And then the frameworks around lethargy and succession planning are similar to what we follow for CCP. Rakshit, if you could move to the next slide. Yeah, thanks. On valuations, what we have found using our data crunch over the past 5, 10, 15 years is that companies which are able to compound book value per share or even earnings at a consistent rate, these are the companies which are able to generate shareholder wealth. And over long periods of time, we have found that entry price to book multiples for lenders do not matter. So even if you were to enter a lender at a high price to book multiple, anything say 4, 5, 6 times is generally considered a high price to book multiple. You will see that as long as the earnings in the book value per share is compounding at 20-25%, your shareholder returns will also be in that sort of a range. And what we did was over the past 5, 10, 15 years, we took the universe of all banks, all NBFCs, and saw that the book value per share compounding was plus minus 1-2% of the share price CAGR. So if you were to take a 5-year period and look at the table on the bottom left, if the book value per share compounded at 6%, the share price CAGR was 8%. Similarly, over a 15-year period, the book value per share CAGR was, if it was 15% for the lender, then the share price CAGR was 16%. On top of that, we did another exercise to see that what happens if we were to simply invest in lenders which have higher than average price to book. So we took the whole universe of all listed lenders, divided them into 2 parts, one with lenders which have higher price to book multiples than the average, the other with price to book multiples lower than the average, and then found out the returns over 5, 10, 15-year periods. And then what we saw was that actually it works the other way around. The lenders which have a higher price to book outperform the lenders which have a lower price to book. And the reason that happens is lenders, because they need to raise capital consistently every, say, 3, 4, 5 years, the lenders which have a higher price to book multiple end up diluting the existing shareholders less. So say if a lender raises capital at 5 times price to book, the dilution to shareholders will be much lower than a lender which raises the same amount of capital at 1 time price to book. So as a result of that, what we have seen is that what we need to focus on is lenders which are able to consistently compound earnings, consistently compound book value, and leave price to book multiples as a side, leave price to book multiples aside and just focus on the fundamentals and the growth of the business over the next few years. The other perception is that if we invest in lenders with low price to book multiples, then we'll get some sort of downside protection. So one school of thought is that if you invest in lenders with low price to book multiples, you'll get upside because we'll see lenders getting re-rated. The left side of this slide shows that is not the case. 90 to 95% of share price is driven by book value per share. The right-hand side of the slide shows that not only do you not get any upside, but there is no downside protection either. So if you were to take the 2 biggest crises that we have seen over the past 10-15 years, whether it be the global financial crisis or the recent COVID crisis, what we've shown on this chart, these 2 charts, is that if you were to take the pre-crisis price to book for a HDFC bank during the global financial crisis, that was around 5 times. And it was amongst the major lenders then, it had the highest price to book at around 5 times price to book. However, its correction during the global financial crisis was actually amongst the lowest. A Bank of Baroda or a SBI, even though they used to trade at 1.5 to 2.5 times price to book, saw a similar or a higher correction than a HDFC bank. Similar was the case during the COVID crisis of 2020. A Bajaj Finance, a HDFC bank or a Kotak bank, they had high price to book multiples. And despite the fact that a Bank of Baroda or SBI had 1 or even less than 1 times price to book multiples before the crisis, they again saw a similar or a higher correction or a drawdown than a HDFC, Kotak or a Bajaj Finance. So the eventual conclusion out of this slide is neither do you get correction, neither do you get a downside protection during market drawdowns by investing in low price to book multiple lenders, nor do you get the upside by investing in these lenders because they will somehow re-rate. What is at the core of share price compounding is earnings growth and book value per share growth. And therefore, if we look at Kings of Capital in that light, if we look at the book value per share compounding over the past 10 years for the KCP stocks, we see that the 10-year book value per share compounding has been 23%. And this is after taking into account, because these companies need capital, they raise capital every, say, 2, 3, 4 years. This is after taking into account all of the dilution that's happened over the past 10 years. After that, we've seen that 10 years book value per share compounding is 23%. If we were to break that down again into periods of 5 years each, it's accelerated over the past 5 years. So FY 10 to 15 BVPS compounding for these stocks was 22%. That over the past 5 years has been 28%. And this is despite the fact that over the past 5 years, we've seen multiple macro headwinds, multiple macro events, which have specifically impacted the financial sector. So whether it be COVID recently or demonetization, ILFS crisis, Yes Bank DHFL crisis, or the introduction of GST, all of these macro events impacted the financial sector. Despite that, we've seen healthy compounding over the past 5 years. And again, if we were to break that down into periods of 3 years each, we've again seen that the book value per share compounding is actually accelerated over a period of time. And it's not that because these companies have grown larger in size, they stop growing or they start growing at a lower pace. So if you were to look at 10 to 13, 13 to 16, 16 to 19, even during 3-year periods, we have seen that book value per share compounding has actually accelerated from 22% to 28% in the recent 3-year period. And the reason that this is happening is, as we see more and more crises emerge in the financial sector, it actually benefits these financial sector companies. Because a crisis cripples companies in the financial sector more, because a crisis cripples weaker lenders, weaker banks, weaker NBFCs, more than a non-financial company, because these are leveraged entities, we see that the kings of capital lenders will eventually keep on benefiting as we see more and more crises like demonetization, COVID, ILFS emerge. What we saw on the previous 2 slides was historical. The reason that we believe that 20-25% sort of compounding will continue or even accelerate is because we have seen historically that high quality lenders typically gain market share post a crisis. If we take the example of HDFC Limited during the crisis of the late 90s or HDFC Bank during 2008-9, we've seen that during a crisis, even these companies see an increase in NPAs. So for example, HDFC Limited saw its NPAs double from 0.5% to 1% during 98-99. However, post the crisis, it saw its return on equity being its highest ever in its history at 24-25%. Same was the case with HDFC Bank. During the crisis, it saw its NPS double from 1.5% to 2%. However, post the crisis, it saw its NPS come down to 1%. It saw its growth go back to 20-25%. Along with that, ROEs went back to 20-21%. And that is what we are very likely to see again. Because of COVID, we have seen that most banks, most smaller banks, most NBFCs are struggling to raise liquidity, are struggling to raise capital. They're struggling with their own issues around asset quality. However, if we were to look at the lenders in the Kings of Capital portfolio, on the bottom of the screen, we can see that the NPAs before COVID for the portfolio were around 1.8%. Despite what we expected to happen because of COVID, we expected that NPAs would double or even more than double. The NPAs have actually been quite manageable for the KCP lenders. They've increased from 1.8% to 2.6%. And more importantly, the KCP lenders have strengthened their balance sheets over the past year during COVID. They've increased their provision coverage ratio from about 50% before COVID to 80% in the latest quarter ending March 21. So even on increased NPAs, they've increased provision buffers. Despite the increase in provision buffers, which is what we can see is, which is in the first column of the table at the bottom of the screen, what we can see is the tier 1 ratios have increased from 18% to 21%. So despite an increase in NPAs, despite an increase in provision coverage ratios, the tier 1 capital of the KCP lenders have actually increased over the past year or so. And that is why we believe that they're well poised to gain market share, with good balance sheet strength. And even if we were to look at the recent 2-3 quarters, the quarter ending March, the quarter ending December, we've seen that the KCP lenders across the board have grown their loan book at about twice the rate at which the banking sector has grown. So in the quarter ending March, we saw that quarter-on-quarter annualized loan book growth for the KCP lenders were around 27-28% versus 12-13% for the banking industry. So yeah, I'll stop here. Back to you, Rakshit.
Thanks, Sej. Before we open up to Q&A, I just wanted to show a simple risk return matrix here. which compares CCP, KCP, and LCP. Because many of our clients, some of them who are invested across all the products, they ask us about how much should be allocated to which product, and there are some clients who say, if we have to start a relationship with Marcellus, should we kick off with CCP or KCP or LCP? What is the difference? I mean, a very simple way to put it is KCP is sectoral. Thematic, LCP is small cap, CCP all cap, etc. But I think the explanation has to go much beyond that, and hence we thought that we'll put it in a very scientific way here. So when you look at this slide, what we've done is we've created two XY charts. On the left is the chart that shows the outcome on risk return, on risk reward, for a time period less than 3 years, and the chart on the right is showing the outcome for a time period greater than 3 years. Right, on the horizontal axis is the return, which is sort of the performance that the portfolio is expected to deliver, and on the vertical axis is the risk that can bring in volatility to that performance. Right. Now, to begin with, before we start understanding the conclusions from these two charts specific to the three funds, to begin with, a few generic concepts worth understanding very clearly. So first and foremost, the conventional measures of risk, right, which is sort of things like standard deviation, Sharpe ratios, etc., they're actually very incomplete in nature. They should not be used if you can go deeper than that, right? And how do you go deeper than that? So first and foremost, let's understand the deficiencies of the conventional metrics. So first of all, standard deviation or Sharpe ratio is going to measure historical share price volatility. Now, you might remember when we showed the longevity framework, the one of the risks that we measure is succession risk, which, for instance, could be the resignation of a key man CEO, or retirement or expiry of a particular key man promoter, let's say, right? Now, if in a particular case, let's say that is a massive risk, key man is a massive risk, but a key man event of either succession or retirement or resignation, etc., if a key man event has not played out in the past, then the share price doesn't reflect that risk in its standard deviation, right? Because it has never happened. So the risk is not part of the historical share price. Likewise, there's actually a second problem with using standard deviation, Sharpe ratios, etc., which is that standard deviation just measures the volatility, right? Now, there's some volatility which actually is good to have, and some volatility which is bad to have. Obviously, the one which is bad to have is things which can bring the performance down into the negative or moderate it, etc. The negative impact of a risk. Whereas there are risks which can actually pull up the performance as well, right? It could be discovery of a particular stock by the broader market, and hence a permanent re-rating upwards. It could be some sort of an overhang that perhaps the market had, which goes away, etc. Those upside risks, there are several types. They are actually not apple to apple in your requirement of risk measurement compared to the downside risks, right? And standard deviation just doesn't differentiate between upside risk and downside risk, but you need to as an investor. So that's as a starting point itself, the definition of risk has to be different. Now, what do we do? So at Marcellus, that framework that we showed you, right? This piece. So here the second, third, and fourth verticals are basically risks, and the first vertical is a return, right? At Marcellus, we have our proprietary ways of, first of all, quantifying these risks, right? So, for instance, the quality of board of directors of two companies, even if they both are very good quality part of our portfolio, but the quality of board of directors, if it is a little bit higher and lower versus each other, then it has to be quantified in some shape or form to get factored into the longevity, because longevity is effectively an outcome of risk, right? The higher the risk, the lower the longevity. The lower the risk, the higher the longevity. And hence, first and foremost, we need to quantify these three parameters which measure risk. The return, obviously, earnings growth, ROC, is a quantified piece, and then comes the interplay, right? So as we've highlighted in this first bullet under the second bullet under the risk reward metrics, the interplay of different risks vis-a-vis each other has to actually be in sync with the objectives of the fund, right? Now, if the objective of the fund is to be able to swap one risk from another, and hence, if there are, let's say moat risk and lethargy risk, if a company scores higher on one, lower on the other, compared to another company which scores lower on the first and higher on the other, right? There could be a fund construct which says that we are indifferent to which specific risks are within the pool of risks, as long as the total risk is contained, right? In that sort of a case, you have to do, I mean, let me put it in a scientific manner, you have to do arithmetic progression of risks. You have to add up all the risks together. Whereas there can be another philosophy where certain risks are critical. You cannot substitute them with anything else. And hence, it's not just the whole pool of risks that you want to optimize. You actually want to optimize individual risks at times as well. In which case, obviously, you put those risks more in the geometric progression rather than arithmetic, etc. Right? So there's a proper science behind how you treat different types of risks differently for different funds for the same stock, right? So, for instance, if Bajaj Finance is held in Kings of Capital and Bajaj Finance is also held in consistent compounders, the role that Bajaj Finance plays in Kings of Capital can be different from the role that Bajaj Finance plays in consistent compounders if the interplay of these risks at a fund level is different for the two funds, right? So that's something worth appreciating, and hence, I mean, people who say that if we've got X% in Bajaj Finance via this fund versus Y% in Bajaj Finance via another fund, we've got the exposure X plus Y. It's actually usually not X plus Y, because the fund manager might be looking at that allocation slightly differently, given the risk reward interplay being different. So that those are the broader fundamentals that you've got to be conscious of, cognizant of. And when you then put the three products that we have on the risk reward metric here, for shorter time periods, obviously Kings of Capital and Little Champs are a little more volatile in terms of share prices of banks and NBFCs, because they're leveraged, go up and down a lot more than share prices of, say, paint companies and adhesives companies, etc. Because of lack of liquidity, maybe Little Champs companies have a little more volatility than consistent compounders, where lack of liquidity is not a volatility creating factor in consistent compounders. Likewise, there are various other aspects which play out in the short run. All of them, some of them sort of normalize in the long run, and hence, when you move from the left-hand side chart to the right-hand side, the width of the ovals, which sort of is trying to exemplify the volatility risk involved in the performance. The width of the oval shrinks significantly, right? Averages remain more or less the same, as in average return of CCP versus KCP. The averages are vis-a-vis each other, similarly positioned in the two charts on the return side, and hence, an investor actually then has to choose what sort of a risk reward profile you want. One other point to note: we've divided both the charts into 4 quadrants. All 3 of our products are sitting in the bottom right quadrant, which means that compared to, say, the standard definition of high risk, high return or low risk, low return, all three of our products are bedding down the risk because we are all quality oriented portfolios. All three of them are quality oriented portfolios. They bed down the risk to a significant level, and they don't compromise on returns whilst optimizing risk. Right. So those are the ways. And Ashwin, Tej, you want to highlight something else on this chart?
Yeah. So Rakshit, as you said, when you consider the investment horizon of less than 3 years, so liquidity does play an important factor in the share price return for small cap companies. So one is that there will be a bit of even when we consider the earnings from a near-term perspective, there could be a bit of volatility. So as I said at the beginning, because these companies are small, so any strategic decision could have a near-term impact on earnings. Similarly, on the positive side, even for example, they diversify into one new product that turns out to be successful, that can have a disproportionately positive impact on the near-term earnings. Coming to the share price level, besides there is a liquidity which can be a booster. So it works actually both ways. So during period of market dislocation, you will actually not, because of the lower liquidity, actually you will not find much takers for the small caps. So that kind of accentuates the impact on the share price level. Similarly, when we talk about the upside, so which I think we have been witnessing for the last 1 year. So basically there will be a hordes of a buyer for the small cap. So that again pulls up the return. But as we move towards the more than long-term investment horizon, I think both. I think particularly earnings volatility tends to come down, because the business reaches a sizable level, So as a result, they are able to absorb new things in a much better fashion. I think So I think from a less than 3 years investment horizon, I think there will be a lot of kind of volatility in the Native Jam space will be on a higher side. But as we move towards a little bit longer term horizon, I think the deviation between CCP and LCP, or even between, say, the worst and the best outcome, that tends to be significantly lower.
Yeah, on Kings of Capital, because it's focused on financial services and the lenders are leveraged, that is the reason that over a shorter period of time, over say 1 or 2 year period of time, maybe you'll have some amount of higher risk because of the inherent leverage which is present in the lenders in the portfolio. However, given the fact that it is a sectoral fund, the perception is that the risk, because it's a thematic or a sector-focused fund, is higher. But on the other hand, what we've done in Kings of Capital is it is not only consisting of only lenders. Even within lenders, we have banks and NBFCs. Even within banks and NBFCs, we have, say, a small finance bank versus large banks versus housing finance company. But apart from the lenders, we also have the non-lenders. Within the non-lenders, we have life insurance, general insurance, broking, and asset management. So we are playing all parts of the financial services industry in India. It all falls within the ambit of financial services as a sector, but within that, it has multiple segments, and therefore there is natural diversification within the portfolio. So over a shorter period of time, given that a part of the portfolio is invested in lenders and is leveraged, we might see some amount of volatility, and therefore we can see that KCP is leaning more towards Little Champs rather than CCP. However, similar to Little Champs, over a longer period of time, we'll see that the gap between CCP and Kings of Capital will also narrow.
Yeah. So this is simple performance data. Many of you will be aware, and books. The next one is coming out very shortly. The one on the extreme left. So we'll stop here. Pramod, back to you. We can answer some questions.
Sure. Thanks, Rakshit, Ashwin, and Tej. That was fascinating as ever. So we've got some really interesting questions lined up. I hope we have enough time to address all of them. But like ever, if you're not able to address any of the questions, if we have your email ID, we will reach out to you with the answers. But please do write into sales@marcellus.in should you have any questions about the product in terms of how you subscribe and so on. So starting off, Rakshit, question for you. One of our clients has noticed an interesting trend from your presentation, which says that whilst the FCF growth trend has been fairly consistent, and in fact, in some ways it's been accelerating, the same can be said about sales and earnings growth. In fact, particularly the last 5-year period, you can see sales growth across many of our companies slowing down. The earnings growth has been better than sales growth, suggesting some operating efficiencies. The FCF growth is clearly better than earnings growth, suggesting some capital efficiencies as well. But surely there has to be a limit for these efficiencies to play out. So unless and until you reckon that the economy picks up and sales growth eventually picks up on the back of that, will this sort of FCF growth sustain into the future?
Very good question, I would say. So thanks for noting this particular aspect, and the answer has to go again very deep. So first and foremost, let's understand the history, and then I'll come to the prospects in future. In the past 5 years, okay, actually, let me whilst I talk, let me present a very interesting slide on this subject. Right. So now, if you look at this and see what is happening here, right? Volume growth for Asian Paints over the last 5 years has not been any more muted. I mean, it's not been a moderation compared to the preceding 15 years. Right. So that's the point number one. Volume growth has not moderated, but look at the gap between sales CAGR and volume CAGR. That has compressed. In fact, for Asian Paints, it has gone into the negative. Right now, when it comes to say our portfolio, you combine Asian Paints, Berger, Pidilite, all three have seen this particular thing play out exactly this way. Even if you include, say stocks like Nestle, so roughly speaking, around 40% of our portfolio has undergone a moderation in sales growth without having undergone any moderation in volume growth. One of the biggest reasons for this is the fact that over the last 5 years, there's been a massive deflation in crude oil price and hence their derivatives, which are used as raw materials here. Over the last 5 years, as a result, Asian Paints has taken multiple price cuts. So has Pidilite, right? Barring say the last 6 months, in fact, every 12-month period over the last 5 years, barring the last 6 odd months, has seen a price cut, right, by Asian Paints because input costs were going down. So that's one very big component playing out here, right? Which is the reason why when you look at, let's say, 11 to 16 profit after tax compounding versus 16 to 21, the moderation is not that stark as it is in the sales growth moderation, right? So that's factor number one. Factor number two is that when you look at almost all of our portfolio companies, till about a decade ago, they were not as tech invested as they have been now, right? So till 10 years ago, Dr. Lal Path Labs had absolutely no tech. I would say it was running on Excel sheets. Till 10 years ago, Asian Paints' tech investments to drive revenue growth, volume growth were far lower. Predictability of business was a lot less than it is today, right? A firm like Page Industries, over the last 3 years, the kind of tech transformation, the digital transformation that Page Industries has gone through is something that the firm had never seen in the past, right? So today, there's things like auto replenishment of the distribution channel. They've given out tablets to their entire third-party sales team of distributors, right? Not just to their own employees. And all of that is helping run a very digital interface of the business, right? Now, these massive tech investments, which have gone in to drive efficiencies, they are obviously creating moats. Many of them are going through the P&L, cannot be capitalized. They are expensed. Hence, they are having an adverse impact on profitability. Because in a way, you can say tech capex, right? Technology-oriented capex goes through the P&L, unlike fixed asset capex, which goes directly on the balance sheet, right? When you're setting up a new plant, you're buying land, it directly goes on the balance sheet. It doesn't suppress earnings. But when you're paying Salesforce.com, or when you are building tech capabilities, all of that goes via the bulk of that goes via the P&L. And hence it suppresses earnings, which in a way is an artificial compression, because it is not compromising on free cash generation, because free cash flows are independent of whether capex happens on the P&L or whether capex happens on the balance sheet. It is only compressing the profit after tax, right? So those are some of the most common reasons for free cash flow compounding of our portfolio companies being significantly faster than their earnings compounding, particularly over the last 10 years. Right now, how much more can this progress? In fact, as many of you would be aware, tech-related efficiencies have network effects, right? Whether that be network of brick and mortar, which is running on tech, or whether that be network of information, which in the case of, let's say, Asian Paints is a lot more intangible than it is in Dr. Lal Path Labs, which is a lot more hub and spoke execution basis tech, right? Whichever way it could be, if it is predictive or brick and mortar, there are network effects to benefit from. The larger you get, the more efficient you become. And as long as penetration is not a challenge for the categories of, let's say, diagnostics or of home building materials and adhesives and stuff like that, as long as penetration runway is there, the network effects, basis tech, and hence the free cash generation being higher than earnings growth is a phenomenon that I think you will see more and more, especially for companies where earnings growth gets suppressed by capex happening via the P&L. Right, so those are certain themes worth bearing in mind, and hence when we look at the next 5 years, things like COVID in particular have accelerated the dependence that an Asian Paints will have on tech to radically disrupt the entire industry around quality of labor being the driver of market share rather than supply chain efficiencies being the driver of market share. Right, and that's one example, for instance. Similarly, in the case of a Dr. Lal Path Labs, previously it was efficiencies across hub and spoke brick and mortar execution. In future, it will be more around, say, whether it be home collections infrastructure, which runs on network effects, or whether it be geographical scale in a relatively more asset-light model or franchisee outlets, etc. Where again you'll see a lot of use of tech, etc. COVID has accelerated these transitions. The transition to home collection for diagnostics, the transition to labor services for Asian Paints, the transition to say e-commerce for a Page Industries. Tech is accelerating. COVID has accelerated that, and hence over the next 5 years, I think this trend will only accelerate further. Free cash.
There's another aspect of what I think this person is asking, which I think we can help him with. So a lot of investors suffer from money illusion in a high inflation climate when oil prices are going up and an Asian Paint hikes prices. The revenue growth looks bigger. But the free cash flow compounding, as Rakshit showed in the preceding slide on Asian Paints, the free cash flow compounding the last 5 years has been just as impressive as the first 5 years of the century, right? What this slide, the slide we're all staring at, what this is comprehensively showing everybody who's watching, I'm hoping, is that the main driver of your wealth is not revenue, it's not profit, it's free cash flow, right? So as they say, top line is vanity, bottom line is sanity, cash flow is reality. The cash flow is the reality, we're all staring at it, that drives your wealth, the right hand side, the share price compounding, right? Now, if out there any of you are very fussed about, you really want to see high revenue growth, all you need is a high inflation climate with oil prices pushing towards $100. It looks like we've entered that world because of the $11 trillion of quantitative easing that the global central banks have injected. You've got a roaring economic recovery the world over. If we go through now 4-5 years of high inflation, everybody on this call, you will get 20%, 25% revenue growth from Asian Paints or from Pidilite. But your compounding, our compounding will stay the same. It'll stay in this vicinity of 25% free cash flow, 25% share price CAGR. The main thing all of us need to focus on free cash flow rather than the optical illusion of revenue growth. Revenue growth will look higher in a high inflation climate. And as Rakshit said, the last 5 years, we've had a deflationary climate. Oil prices were going down, Asian Paints and Pidilite were cutting prices, but that didn't hurt you and me because you can see the last 5-year free cash flow. If you look at the FY 16 to 21 column, the last 5 year, in the last 5-year period, Asian Paints is giving you free cash flow compounding of around 20%. Even a Abbott or a Nestle, right? Someone as like Nestle selling a basic product is giving you 15%. Why is that coming? Because in a time where revenue compounding is modest, they're pushing through working capital gains. Now, how much can working capital gains be, right? You can set the number, it can be enormous. 25 years ago, Asian Paints' working capital cycle was 100 days. Today, it is 10 days. And Nestle has actually taken it negative. So there's a lot of juice and wealth to be squeezed here, provided people on this call don't get seduced by the notion of revenue growth, and most specifically, the notion I think we're trying to push back very firmly on is that low PE will make you wealth. Low PE is not going to make you or us rich. What we need to focus on is these free cash flow compounding machines, and whether inflation is high or low, these are all weather compounders who are delivering wealth at basically 10x in 10 years, and incredibly 100x in the last 20 years. These companies, many of them were market leaders 20 years ago, say Pidilite or an Asian Paints. From then, they've given you 100x. Were you fortunate to be invested? Every single company on this chart is a market leader. There's another way to think about this, right, which helps you get over this illusion of what is the revenue growth, what is the profit growth. As Rakshit explained very eloquently, every single company here is driving powerhouse compounding using science, using technology. So an Asian Paints is using SAP, a Divi's lab is using their specialism, their world-leading skills in chiral chemistry, right? But these are all companies built on intellectual property. These are empires of the mind. None of them are saying we are going to build a steel plant or a cement plant or a real estate business or a construction business. Why aren't they saying that? Because in building steel plants, in building cement plants, in building construction businesses, your return on capital cannot be the 35-40% which we are looking at. If your return on capital is more modest, your free cash flows are lower, your compounding of wealth is lower. So if you want to get rich in the next 10 years in India, you want to consistently grow your wealth, look for companies whose businesses are based on intellectual property, on science, on tech, because the empires of tomorrow are the empires of the mind.
Great. Thanks, Rakshit and Saurabh. So again, given the paucity of time, we'll request you to drop your Q&A with your client code so that we can come back to you with answers to questions we won't be able to answer here. For the benefit of everybody, we'll try and answer more questions around the investment philosophy, which can be applied across multiple portfolios. So I'll switch to both Ashwin and Tej, sort of common questions. The question around Little Champs is, we built the Little Champs portfolio on the pretext that there are a whole host of companies which massively compound while they are below the BSE 500 before their entry into the BSE 500. But we've also demonstrated that post-entry, that sort of compounding slows down, partly because the discovery element goes away. How do we view that in terms of holding periods of our companies? In fact, several of Little Champs companies are already part of the BSE 500. Does that mean that they're already discovered and hence there isn't enough much potential and they start underperforming from here on? Related to that is a corollary question around small cap cycles. As an asset class, small cap is far more cyclical, while the underlying businesses might be more consistent, given the neglect effect of small caps by the market in general. You'll see that volatility. How does that drive our holding periods of Little Champs companies as opposed to CCP, which are sort of relatively more evergreen companies? So question to you, Ashwin, on that.
Yeah. So actually, kind of answered this in my presentation, but yeah. So I think, the point is valid that, for whilst on their way to BSE 500, the small cap companies deliver significantly better returns. But history suggests that as these companies enter BSE 500, there is a period of underperformance. The key reason for this underperformance is, again, going to our lethargy framework. So I think when the business is, for example, some reasons that come to my mind are, so when the business is of a certain size, I think the promoters can very well drive the business. But if as the business keeps on getting bigger, scales come in, you're entering new ventures. If you're not bringing in talent from the market, you're not delegating it, I think that business will eventually saturate or either even fail, basically. So that is one reason which I think our this lethargy framework very well addresses, that we keep on evaluating companies on this parameter. Secondly, again, there will come a point where, particularly if you're into niche businesses, you will hit a ceiling limit. So constantly you have to endeavor into expanding your addressable market again. So you have to take your business from local to regional to national to export a global business. I think that is how you expand the addressable market, or you should get into adjacencies, basically. So I'm not talking about you should get into completely unrelated businesses, but you can actually, most of these companies, little chap companies, for example, Garware Technical Fibers used to be a market leading Indian franchise in fishing nets 25 years back. Then it went into export markets, then it went into the aquaculture market globally. So at the core of there is basically their specialization into polymer engineering. So that was the core capability which they have, and they leverage that to expand into newer areas. So that is one example. GMM Folder example. GMM Folder is another example. Historically very strong in glass line equipment. And using the dominance into glass line equipments, they were able to push new products to the same set of customers. For example, filtration equipment, drying equipment goes into the same set of customers. So, but this is kind of a rarity actually in the small cap space. So either the promoter gets lethargic, there is a hubris and arrogance which builds in most of the time. So as a result, you see that more often than not, after reaching a particular size and scale, most of these companies either saturate, they hit a ceiling limit, or in fact, in most of the case, we also see promoters going for unbridled expansion actually. So they may go into businesses which are completely different from the core businesses. So that is the reason why, you
Folks,
see that
it's worth giving clients visibility that this is something that we don't sit back and just let the promoter do whatever he feels like. Both in Little Champs and in CCP, there have been instances, just off the top of my head, there's a promoter where we felt he should have an ESOP scheme in place. We gave the suggestion to the promoter's credit. He launched an ESOP scheme 6 months later. There's another promoter where we felt his CFO wasn't up to the mark. So in terms of succession planning, they internally homegrown CFO wasn't up to the mark as the firm became larger and larger, became a multi-billion-dollar enterprise, and we helped the promoter think about bringing in a new CFO. The new CFO has subsequently been brought in. Similarly, in our CCP framework, Rakshit had spoken about some of the exits from CCP in the past where we didn't see eye to eye with the companies on capital allocation. But there are other CCP companies which continue to be part of the portfolio where we've had a big influence on succession planning. So whether it's CCP or LCP, as my colleagues have discussed, the right-hand side boxes, the lethargy and succession boxes, are enormously valuable for driving long-term compounding. And that's where not just our internal research process, but also our engagement with the investee company's boardroom comes into play. And we are managing 7,000 families as wealth. We can't hold back. We're very frank in our engagement with the promoters, with the CEOs. We are hard-hitting in our recommendations. And if we don't see the recommendations being followed through by the investee companies, in due course we exit. There have been exits made both from CCP and LCP if we believe the companies are not doing well on our lethargy and succession planning frameworks. So it's a very clinical process, folks. We're not wedded to these companies in the sense that we understand and appreciate the power of their franchises. But if we see these franchises are stagnating, they're becoming lethargic, their succession planning is not up to the mark, we are constructive in our inputs. And if those inputs are not followed through, we are clinical in our exits.
Great. I think a related question to Tej on the cyclicality of lending businesses. Lending businesses, by definition, are cyclical. They tend to go up and down with the economy. Plus, the leverage of the business model also means that they're even more cyclical in nature. How should one see holding periods in lending businesses, or how do we manage in the exposure to lending and non-lending businesses in the Kings of Capital construct to adjust this cyclicality? I think we did highlight this at the beginning or during the launch of the strategy. It's worth reiterating that aspect, Tej.
Sure, yeah. So there are two aspects to the cyclicality of Kings of Capital. One is the macro aspect of it, because these are linked to the macro economy more than maybe other companies. And second is the inherent leverage in these businesses make them cyclical. And there are two aspects that we highlighted. One is that if you were to look at simply a Kotak Bank or HDFC Bank or even the Bank Nifty, we've shown that the volatility or the downside deviation for the Bank Nifty at an index level itself was quite similar to the Nifty. The second aspect that we highlighted was if you were to look at drawdowns for the Bank Nifty at an index level, then again the drawdowns for the Bank Nifty were actually lower than the drawdowns that we saw for the Nifty. So over the past 20 years, what we had shown was the number of times that we had seen 3 consecutive quarters of negative returns and drawdowns for the Bank Nifty were 4 times versus 11 times, so about 3 times that of the Bank Nifty for the Nifty. So 4 times we'd seen 3 consecutive quarters of negative returns for the Bank Nifty versus 11 times for the Nifty. So that is one aspect of it. Second is if we were to look at it at a stock level, which shown that even if we were to identify periods of drawdowns for the sector as a whole, we've seen that in 50% of cases where the Bank Nifty had delivered negative returns, HDFC Bank and Kotak Bank had still delivered positive returns. And this is because of 2 reasons. One is that the P multiple compression for high quality lenders is lower. That is what we showed in one of the slides. Second is because these lenders are able to offset the P multiple compression by 20-25% sort of earnings growth. Again, they are able to offset the compression by showing positive share price returns. However, given that we still need to manage the cyclicality, what we had earlier highlighted was we have 2 parts of the portfolio. One is the lending part of the portfolio where we have allocated about 60-65% of the portfolio. The other is the non-lending part of the portfolio, which consists of life insurers, general insurers, asset managers. Because these are businesses, the non-lending part of the portfolio consists of businesses which are not leveraged or are leveraged only 2 or 3 times versus lenders are leveraged 6, 7, 8 times. These companies have lower volatility. Because non-lenders have lower volatility, what we had highlighted was we'll be able to toggle between the lenders and the non-lenders when we are able to see that the economy is heating up, whenever we are able to see that a lot of, say, IPOs or QIPs of housing finance companies or lenders are happening, and we're able to see that low quality lenders are able to raise money cheaply from the CP market, we'll be switching and toggling from the lending part of the portfolio to the non-lending part of the portfolio to manage this sort of volatility in the Kings of Capital portfolio.
Great. Thanks, Tej. One other question on monopolies. I think given we keep reiterating that we're interested in businesses which have a monopolistic competitive position, client of ours has highlighted a whole host of monopolies that he sees in the marketplace and which don't figure in our portfolios. Most of them seem like regulated monopolies, the likes of, say, IEX, the India Energy Exchange, which has a dominant position in power trading in India, or Container Corporation, again, dominant position in logistics, or CDSL, a depository participant, for that matter, even the Bombay Stock Exchange, or IRCTC, the biggest online railway ticket vendor. Why don't these sort of monopolies feature in our portfolios is the question. So over to you, Saurabh or Rakshit, if you can handle that.
I think a lot of these monopolies are optically monopolies in the sense that their pricing power is zilch. So in several of the examples, Pramod, you mentioned, our analysts, Rakshit, myself, we have spoken to the customer base. Customer base could be mutual funds, they could be banks, they could be brokers. And the customer base has said it's very easy to extract price reductions from these companies because these companies actually don't have that much pricing power. So I think one needs to be careful. I think whoever's asking the question is using market share as a proxy for monopoly strength. Many of these examples that were cited do have high market share, but they actually have very little by the way of pricing power. And you can see that quite easily in their numbers. You'll see that their revenue growth, many of these franchises that were mentioned, their revenue growth is slower than their volume growth, which means the customer base constantly gouges out of them price reductions. As a result, EPS compounding doesn't actually keep up with volume growth. EPS compounding tends to be on the 15 to 20% mark at best. And the customer base, when we talk to them, makes it very clear that they hold the cards. In some instances, we've also heard from the customers are working actively to create industry, what should I say, trade association type constructs where the trade association will disintermediate. The trade association will get rid of the third-party supplier who currently might be listed and might be earning a, say, 20-25% ROE. And the various industry participants are getting together to disintermediate the existing listed player. And then the next layer is the blockchain. The blockchain is an obvious threat to many of these platform-based monopolies. The sorts of tech businesses which are interesting are twofold. One is, say, a monopolistic platform like, say, InfoEdge, where the Naukri.com platform genuinely is a powerhouse platform. No HR officer in India can do their work properly without a Naukri subscription. And what the InfoEdge management team have done spectacularly over the last 20 years is the kind of point Rakshit was making. They've taken the Naukri free cash flows and reinvested them successfully in Policy Bazaar, Zomato, so on and so forth. And thus the free cash flow compounding of the InfoEdge machine is well in excess of 25%. The other type of tech businesses where India excels is businesses like TCS, where free cash flow compounding has been 25%. And as Rakshit explained, because businesses which are businesses of the mind, businesses where once you get the tech, the science, the R&D, the training, the network built, you get into a virtuous compounding loop. So businesses like TCS have shown that you can compound free cash flows at 25% and shareholder wealth pretty consistently at 20%. So those are the sorts of tech businesses we are interested in. They form some of our portfolios, some of our offshore portfolios. We're also thinking about should they be part of some of our onshore portfolios. But these market infrastructure platforms, the sort of stock market, financial market infrastructure platforms, wahan pe there is no monopoly worth talking about.
On Kings of Capital, there's a question around valuation. While you've explained the valuation using a non-conventional DCF in the CCP and LCP context, obviously there's no cash flows in lenders. How do we look at long-term intrinsic value assessment in a lending business? What sort of techniques we use as opposed to multiples, which we've clearly said don't work or don't apply to these businesses?
So the proxy for cash flow. So cash flows for lenders are not relevant because money.
Should we use book value per share? Because there's a lovely chart on book value per share in your deck. It's worth using that.
Yeah. Because cash flow.
There's a table showing book value per share. Yeah, that one.
Yeah. So because cash flow is not relevant for lenders or for financial businesses, what we look at is book value per share compounding. Because if book value per share is compounding at, like we discussed in the earlier slide, if it's compounding at 20-25%, it is very likely that the share price compounding will also be in the vicinity of 20-25%. Just like we explained how we look at longevity of non-financial businesses and now whether they'll be able to compound at similar rates over the next 10, 15, 20 years. We sort of use a similar framework, whether the company is moated, whether the financial company, whether the lender is moated, does it have a competitive advantage? Is the lender being lethargic about its competitive advantage? And is the process, is the company institutionalized or not? And that is how we assess the longevity of a lender as well. The difference being, because there is no free cash flow compounding, we look at book value per share compounding over the next 5, 10, 15, 20 years. And if we look at the historical time periods, whether it be 10 years, 5 years, 3 years in this chart, we can see that over the past 10 years, the Kings of Capital portfolio has compounded BVPS at 23%. If you were to break it up into periods of 5 years each, again, it's been 22 and 28%. And the same story for 3-year periods as well. Now, why do we believe that this will continue? One part of it is because we've followed the same sort of longevity framework that we followed for non-financial companies. And the second part of it is because we are able to see that the lenders in our portfolio have tier 1 capital of 20-21% versus say 10 or 11% for most of the PSU banks. The top 3 PSU banks in India have tier 1 capital of around 10.5-11%. These top 3 PSU banks control about 30-35% of market share versus say the largest private sector lender, HDFC Bank, still only has a 7-8% market share. A Kotak Bank or Bajaj Finance have only a 1.5% market share. So there is a long runway for growth. And these are companies which have high barriers to entry, and these are companies which have adequate capital to capture this growth. And that is why we believe that this sort of historical fundamentals of 20-25% growth can be repeatable in the future as well.
So in fact, there's one way, right? At one level, it's easier to lock into a great compounding machine in the lending world than it is in the non-lending world. So just to give an example, in the non-lending world, say the free cash flow, Rakshit, if you can go to the chart where we showed ROC and reinvestment rate, right? For a non-lender, say for an Asian Paints or Alkyl Amines or for a Nestle or a GMM Pfaudler, we're trying to get a handle on 2 things. Firstly, what is the ROC, right? And the high ROCs, say of the sort pushing towards 35-40%, high ROCs means high free cash flows. So we're trying to get a handle on the ROC. And secondly, we're trying to get a handle on the reinvestment rate, right? Is the company reinvesting at least half of its free cash flows? Because if he's not investing half of its free cash flows, it's not going to give us future growth. So with a non-lender, we're trying to get a grip on 2 different things. ROC, which is basically the translation of the competitive advantage, the moat into a financial metric. High ROC gives you cash flow. And then we try to get a handle on, is this guy reinvesting half of its free cash flow and is he doing it wisely? In lending, ironically, there's only one metric that we really need to focus on, which is return on equity, right? So the analog of ROC is ROE. A lender, if he generates an ROE pushing, say, significantly north of 14-15%, a lender is doing a good job. His return on equity is well above his cost of capital. By definition, a lender reinvests almost everything. right? 90% वो वापस डालेगा, थोड़ा सा little bit will go as a dividend, 90% will be reinvested. So the reinvestment rate वाला issue is actually not there with a lender. In that regard, locking into a compounding lender like an HDFC Bank or a Bajaj Finance actually is much easier than locking into a non-lender, because non-lender mein there are two layers of uncertainty. Lender may just one layer, which is, can the lender consistently crank out a ROE well above his cost of capital? High reinvestment rates are a given in lending. Pramod, back to you.
Just one last question. This is for Ashwin. In some ways, you've addressed it with the framework-driven question, but there's a related question here as well. Given that even our little champs, not all of them, or at least some of them, are at seemingly high valuation from a multiple perspective, we've sort of explained why that's not an issue in CCP companies, given the longevity we consider in their cash flow generation. It's easier to understand the longevity because some of these companies have actually delivered for as long a period as they actually have. Whereas in little champs companies, these have been discovered now, or they're actually performing off late. How do you justify these lofty valuations, or how do you get comfort on the longevity of such companies? Related to that question is, given Little Champs has more of B2B companies, whereas in CCP they're largely B2C, isn't B2C modes far more enduring, which gives you far more confidence in the longevity as opposed to a typical B2B business?
Yeah. So I agree that the track record of these companies are relatively shorter compared to CCP companies. But even if you look at the last 6 years, actually, so last 6 years, these companies have delivered close to 25% earnings growth in a period, of high slowdown in macros, as well as which has been inundated with a lot of disruptions. And that earnings growth has been backed up by, so this framework actually gives us a lot of conviction, actually. So where the earnings growth has come from, the increase in the market, largely driven by the market share, plus they have been expanding their adjacencies, which I talked about. And I think even because of this COVID, as I highlighted, I think this last 1.5 years, what has happened, I think it gives them all the more firepower to continue or accelerate what they have been doing in the last 6 years. So I think that would be my first answer. But we, as Saurabh said, we continue to remain, we continue to monitor these companies very, very closely. So again, because that track record is relatively smaller, I think the last 6 years gives us a lot of comfort. But the intensity of monitoring these companies remain very, very high, actually. So we continue to monitor them very closely.
So why don't we use an example and apply this framework? Can we turn to the slide where the free cash flow compounding of the little champs is shown, and we can then apply the longevity framework in front of our clients? Thanks, Rakshit. So let's take an example. Let's take alkyl free cash flow, right? Alkyl free cash flow, 48%, 16 to 21 CAGR, 88% last year, right? So just step back and think about what's happening here. Aliphatic amines are an essential product for the pharmaceutical industry. So आप Dr. Reddy से पूछो, Divi's Lab से पूछो, ask any pharma company, they'll tell you that they need aliphatic amines. They're basically two players in the country who make it, just two players, right? Out of those two players, only one company, the company Alkyl Amines, invests heavily in science, right? You can see that in its annual report. 2000, go back 15 years, you'll see 2% of revenues consistently going into R&D. Its competitor doesn't have such spend on R&D. You can also see that in the expansion of its SKUs. They've added 100 SKUs in the last 10 years. The competitor hasn't even added 1/10 that. You can also validate that by talking to Divi's Lab, Dr. Reddy, Cipla, as to who's the most advanced, of the two aliphatic amine suppliers in the country, who's more advanced, right? And the emphatic answer will be alkyl amines is more advanced. Now, you can apply the succession planning framework. You see the alkylamines top management, the board, the plant managers. Every single person is either IIT or American chemical engineer educated. They've worked in places like Biocrop Sciences, BASF, right? Top quality backgrounds, top quality management. People recruited at the age of early 30s and gradually over 10, 15 years taken to the boardroom. If you look at the rival, you won't notice that sort of chemistry pedigree, right? So lethargy, science, R&D, alkylamines ticks all the boxes. Succession planning, alkylamines ticks the boxes. Now, all this hard work, all this mental stuff, right? The mental firepower, the intellectual power. What is the result of that? The result of that is the straightforward stuff that everybody sees, profit compounding. I think last 3 years, profit compounding, Ashwin, 40-45% EPS compounding, right?
Yeah, more than that actually.
So 50-55% last 3 year EPS compounding. But more importantly, look at the working capital cycle. The working capital cycle, I think a decade back was 80-90 days. Today, it's now down to, I think, 50-60 days, right? Which means the free cash flow compounding is significantly more than the profit compounding, right? 88% is the last 12 months. They'll sustain high free cash flow compounding for some time to come. Why? Because the profits are going to grow at a hefty rate. How do we know that? Because we're speaking to customers. They're saying we need more and more aliphatic amines as India becomes a larger and larger API hub. So aliphatic amines is an essential product, I stress. Only 2 companies supply it. This company has by far the most powerhouse R&D firing in the system, right? You can see it palpably, tangibly, you can touch it. Over and above the profit compounding, alkylamines is driving working capital efficiencies. Now Rakshit, let's go to your DCF wala chart. Now go to the DCF wala chart. We'll try to give you a sort of speed example of how we work. If we can see, right, our analysts, our fund managers can see free cash flow compounding significantly north of 50% for the next 5-10 years, right? And say after that, let's assume free cash flow compounding becomes a more moderate 25% of the sort that the CCPs show, right? If you have free cash flow compounding of 50% for the next 5-10 years, and uske baad, from year 11 to year 25, free cash flow compounding at around 25%, which is what a typical champion franchise in India shows. That sort of franchise is worth well north of 300 times PE, right? And that's why we don't think about churning our portfolios much. But to get to that conclusion that the fair value of this franchise is potentially north of 300 PE, you have to do a year and a half of research, right? Reading annual reports of 10 to 15 years, speaking to customers of that company, B2B ho ya B2C, understanding what drives competitive advantage in the ecosystem, understanding who are the rival players, what merit do they have in a competitive advantage framework, then linking it all back to how much money will the company make, how much free cash flow, not EPS, but how much free cash flow will it generate, how long will it last, and thus reaching an understanding of valuation. And typically, as we've discussed many times before, the Indian market, the stock market in our country, most fund managers don't do this sort of work, and hence they get stuck at whatever 25, the typical first row, scenario 1. Sometimes if they do a little bit of work, they can get to scenario 2. Very rarely will you find fund managers in India who are able to do the work to get to scenario 3. And scenario 3 is how wealth will be made in the next 10 years, right? Nobody's going to make wealth in India putting up cement plants and steel plants in the next 10 years, or building, high rises, real estate construction. That's last century stuff. Ho gaya hai. That was the previous century, right? This century stuff is about science, alkylamines, about technology of the way Asian Paints uses it, about big data in the way Bajaj Finance uses it. And therefore, this century's wealth compounding is more like the scenario 3 framework. The shift in investing from scenario 1 to scenario 3 is a massive shift, and a whole generation of Indian fund managers are struggling to grapple with that scenario 1 to scenario 3 ka shift.
That's a good note to conclude today's session. It's been fantastic. Thanks Saurabh, Rakshit, Ashwin, and Tej, and thanks to all our clients to have dialed in. Like I said, there are plenty of questions. Wherever clients have left their client codes with us, we will respond to you individually with answers to those questions. Those who haven't, please feel free to write to clientsupport@marcellus.in with your questions, and we'll be more than happy to engage with you on a Q&A session. If not, we'll take up some of the questions left in our next webinar, which will be coming soon as ever. Thank you once again. We enjoyed the session and hopefully you did too.
Thank you.